one question that came in and says, what other default searches do you have for bear call credit spreads? All right. Well, in any strategy, this is from John, I'm sorry. In any strategy, John, there's two ways to look at default or starting points for your searches. We'll keep with bear call credit spreads because you asked about that. So I go back to the search. And here we're looking at our default weekly bear call. So you can customize the search any way you want. You can change the columns. Any column you can sort or filter by for the stock or the option. You can select to view in that field. Okay, so let me just go down here. We're just going to go ahead and submit that and not change anything right now. Okay, so what do I have here? We've got our company name, we've got our symbol, we've got our current price. This particular search, of course, is only looking at one security. So we're only seeing the VIX ones. Now we've got our short option. So in a bear call, what am I going to do? Sell the higher strike call and buy an even higher strike call. We're selling an out of the money call. We're going to buy a higher out of the money call to receive a net credit. As long as the security stays below both strike prices, both calls expire worthless, we keep the net credit. And we've got our break even here, the break even at expiration, historical volatility, short option implied volatility, and the long option implied volatility, as I mentioned, they're still pretty high. The ratio here, usually I want a ratio greater than 1 when entering into a credit spread, but probably not going to see that here with the VIX securities because it's been in the decline. And of course, the probability as well. Now, this is one default search that you can use. The other default searches, when you first start your account, bear call credit number 1. These are standard monthly positions, looking for a good double-digit return, higher than about 10%, I believe, if I'm not mistaken, while still keeping a good probability below, related to delta, but a little bit different. So a probability low of about 70, 74, 75%. What else do we look for? Well, the criteria that you can use in any search, starting with a default, you've got your days to expiration, your time frame to expiration, minimum net credit, percent return, range out of the money, or forcing it to be at least 10% out of the money for the next standard expiration, full standard expiration in this case, which is October. That probability of 70 I mentioned, keeping the bid-ask spread to 50, but we're also looking for some stock criteria, some technical stock criteria as well. Not a lot, but we don't want something that has a very strong broker recommendation, and we're looking for stocks that are below the 50-day moving average. Simple starting point. I can use other technical indicators, looking for stocks where the SMA has been under the 20-day moving average for more than 4 or 5 days, for example, or look for something where the MACD is negative, where the MACD is below the signal line for at least 3 to 5 days, whatever I want to put in there. Those are other criteria you can use. And of course, the fundamentals as well, but you can customize this. The main thing you want to focus on here in the fundamentals, in my opinion, for a bear call spread is I would just want to make sure I have no earnings between now and expiration. If I'm doing any credit or debit spread, I always use this checkbox because I don't want any surprises that I can't control. Yeah, the volatility looks great going into earnings to get inflated premiums for a credit spread or something along those lines. But at the same time, if it beats revenue, it beats expectations, but the future outlook's lower and the stock falls 15%, and I'm in a bull put credit spread or bull call debit spread, I'm just pretty near 100% loss on that trade. All right, it's not worth doing long term. If I am looking for a bullish position, I might look for a certain earnings per share growth, market cap, maybe a PE ratio, but still avoiding earnings between now and expiration. Okay, and of course, that's just one. This is a monthly, as I mentioned. We saw the VIX weekly. But of course, you also have the default weekly bear call credit spreads. And similar thing, we're just looking for expirations that are about 11 to 14 days out in time. We usually look about 2 weeks out in time. Net credit of less than 20 or more than 25 cents. Minimum return of 9%, still being 10% out of the money, but an 80% probability on the shorter term. Again, avoiding earnings between now and expiration, looking for a negative MACD signal and stocks below the SMA 20. Well, you say, well, why are you using 8 to 17 days out in time? Well, if I run it on Monday, it'll be for 2 weeks out. It'll be 11 days technically to expiration. And just through testing and other processes, mainly focusing on bull put credit spreads, we found that the 2 week out series long term, trading wise, both in actual trading and in back testing and things of that nature, it just seemed to work out better. than the shorter term trades. But again, really simple. What can I do? I can use this weekly bear call credit spread default in the search screen, and I can just change the time frame. Let's go 0 to 9 days out in time to focus on next week's expiration. Are there any weeklies that are offering a 25-cent net credit with a 9% return, 80% probability? Okay, and so we've got Elf Beauty, Coinbase, Upstart, Avis, Tempest, and AST Space Mobile. And these are pretty far out of the money. So the Elf's down to 116.63, but it pulled back up today. We're looking at the 129 to 131 strike, midpoint net credit of 30 cents with an 86.1% probability. That 30 cents against the true risk of the 2-point spread, or $1.70, would be a 17.6% return for a 7-day trade. But, of course, everything's been coming back up, including Elf. You take a look at it and say, oh, well, we've been down, but now we're starting to bottom out here, and we're starting to move back up. The MACD is even starting to bottom, but we've got exactly what we look for. We've got a negative MACD where the MACD is below the signal line for at least 2 days or more, but we are starting to see a bottom, which is a little bit nervy. If I was doing a bear call credit spread, remember we were at the, was the 136, did I say? Let me take a look. I apologize, folks. Oh, 129. I'm sorry, 129. And, the stock had almost hit that today. And it had been about 125 before it settled back down. But yeah, we'd be doing the 129, 131 bear call credit spread in this case. I don't know. That one, I'm going to be honest, just based on this balance here, this bottoming, it looks like it's close to it. Be a little concerned about this one for a bear call credit spread. I'd like to see more of a bearish trend in this situation. But as we've noticed, the market has been bullish. And of course, if I run this search on Monday, shortly after the market opens, say at 9:40, 9:45, maybe 10 o'clock, well, whether the market moves up and down, I'm probably going to see some completely different searches here for the 5 days out that we'd be looking for. Okay, we drop down to 5 days to expiration instead of the full 7 days to expiration as well. So that's what you have in every strategy. When you first start your trial, these are ones that we did for customers during the webinars. But for bear calls, you've got 4 initial values is also a monthly screen. It's not looking as far out as the money. The bear call number 1 was going at least 10% out. Oh, this is going 10% out of the money. But I think it's looking for a higher probability. That's it. Instead of a probability of 70% or more, it's looking for a probability of 80% or more, which means you expect to see slightly lower returns. Remember in the bear call number 1 screen, we saw returns 25, 23, 22%. This one here for the 80% probability or higher, we've cut that down to 19. They still look pretty good positions, still avoiding earnings between now and expiration, still looking for a stock trading below the 50-day moving average because this is a monthly screen in that case. So similar criteria that's being used, just a higher probability, so you expect slightly less returns as the bear call number 1. Then you have the weekly bear calls and the VIX weekly bear call credit spreads as well. And you'll have defaults in each strategy similar to that. Weekly, monthly, some with specific criteria. In addition to all of that, under each strategy, you also have sample searches. These are themed searches that help you use better as a starting point. So if you just wanted to trade bear calls on ETFs, 10 to 45 days to expiration, stocks that are in a downtrend sorted by highest probability, I could use this as a starting point. Okay, so we've got SMH, XOP, OIH, SOXX, XLE. Looks like a lot of the energy and mining, doesn't it? Uranium and Invesco now, solar there. So these are ones, what is the criteria? Again, below the 50-day moving average, we could throw in a MACD one in there, still a good probability of 75% or more. And these are monthly to weekly. We're going 10 to 45 days at a time, so it's going to show a broader swath of positions that match that. But I can use this as a stepping stone to evaluate bear calls or bull puts, because under bull puts, under that sample searches, these list of theme searches that you have, you'd see the ETF bull put as well. Same with bull call debit, bear put debit. In sample searches and the debit spreads, you'll also see the one for out in time, out of the money. So positions that have closer to a 1-to-1 risk-reward ratio, but they're closer to 60 to 90 days out in time rather than weekly, 20 or 30 days out in time as well. And then you got their 5-star. This is bullish now, so these are slightly different. The 5-star rated stocks, bull call debit search. There's the ETF one. And safety first, large cap stocks over 10 billion market cap with the high probability. Themes. Theme searches that you can use where we've set the criteria for you just as we reviewed in the search. Focusing on the criteria for the theme, meaning what? Well, we've got that market cap greater than this, avoiding earnings between now and expiration, good earnings per share growth, relatively average PE ratio, but still those other concepts. And, debit here, minimum return, 75% probability, bid-ask spread restrictions, all available for you to adjust. But this is a starting point. Hey, I want those large cap stocks and names that I know for a bull call debit spread, a bear put debit spread. Here you go. What have we got? NVIDIA, Amazon, AT&T, Apple, Chewy, PayPal, Microsoft, Meta, all company names as you heard before, not necessarily newsbreakers, some fast movers from time to time, but not overly volatile considering the rest of the market. We had a discussion about that a few weeks ago. A gentleman was asking about his position on NVIDIA. And, based on the increase and the extremely high implied volatility and volatile nature of the stock, what should he consider? When we looked at it, we just went to the stock research tool. The volatility is average, right? 20-day volatility 0.65 is a little high. 50-day volatility 0.70. 100-day volatility 0.62. It's a little bit higher, but it's right around the average of all stocks right now. That range of, really about 60, 62, 65. That's in the range of the average of all stocks right now. And how do I know that? Well, the reason I know that is because we have a tool that shows you that. It's kind of neat. If you go into the Home tab and we go under Learning Center, we can go to Market Activity. And we have this one called Optionable Stock Statistics. Now, the market statistics is fun too. You get a quick view of today's stock and option market activity. But the Optionable Stock Statistics view, this page is looking at all of the optionable stocks, US stocks, indexes, and ETFs. And it shows us the average, minimum, and maximum price for things such as stock last price, option bid, PE ratio, PEG ratio, for example, price to book. What is the average across the market? Earnings per share growth, book value, market cap, beta. Well, we wanted to go to the volatility. So the average 50-day volatility is actually a little bit lower now that we've settled the last few days. But after that dip that we saw, the average 50-day volatility was around 0.52. That's why I was saying the volatility of NVIDIA being at 0.62, it's above average, but it's not that high. But now this 50-day volatility has dropped to 0.46. So NVIDIA, you think about it, it's still almost 20 to 25% higher with those ranges of 0.62 and 0.70, but it's not double, right? It's not out of bounds. It's not in those one range. There's a 50-day volatility that's at 7.75, for example. So it's not outlandish, more volatile than the average true, but it's not extremely, it's not a biotech. It's not something like that, or Cassava Sciences or something along those lines, but above the average and well above what you'd consider for a large cap stock. I mean, an extreme large cap stock, you think of IBM, McDonald's, Johnson & Johnson. Yeah, they're still at 0.17, 0.18 volatility. Even for the 50, they might be at 0.2. But yeah, NVIDIA is going to be triple that, and the average market's going to be double those as well. That's what you expect, and that's why the good premiums are there, which is why it's fun to trade things like NVIDIA. And what we saw with Amazon, of course, PayPal, been a little bit volatile recently, Meta, of course. But, other ones here aren't that strong, Visa, volatility-wise. Visa, AT&T. I think we had a discussion a couple of weeks ago. Someone asked about, well, would Verizon be a good long-term covered call position? Yes, in the fact that I could do a long-term hold on, say, Verizon. I'm going to get a good yearly dividend, and I can get some extra income, maybe selling a 1 month out, 0.3 delta, 0.4 delta, 60 or 70% probability of expiring worthless, the stock staying below that strike. Okay, that'll be really good. I could do that. But And he said, why monthly? Why not you're selling weekly? It's because there's no premium. Because the volatility on these positions is so low, there's no premium in the short term. You usually have to go out 30 to 40 days to find a good out-of-the-money option that's offering at least a 1% yield to help augment the dividend you're getting on that long-term hold. That's the nature of trading. That's just what it is. Do I always want to trade positions that have the higher volatility? Well, if I do a scan for something that has the highest implied volatility, I'm going to see things such as biotech stocks that have a phase 2 or phase 3 trial coming up soon, which means they could jump up 30 to 35% of their value, or they could fall 90% of their value if the phase 2 or phase 3 trial fails. And in which case, the option premium dries up at that point after the trial. If it drops 70 to 80 to 90%, there's no more premium left at the $1 or $2 price range for that particular security. And I'm sitting holding an 80% loss, depending on which strategy I did. If I did bearish, I'm looking good. If I did bullish, I'm looking bad. Okay. Even with the higher implied volatility. Oh, the covered call on this position, this biotech offers a 25%, 30% downside protection with 11 to 15% return if I'm assigned. How could I go wrong? Well, if it drops 80% because it failed the phase 2 or phase 3 trial, that's where you get caught on those positions. All right. So I just wanted to review that every search, you'll see the same thing. You'll see the search and the default criteria. Let's go to naked put real quick. Cash secured naked puts, weekly picks of the day, tip sheet out of the money puts, and Ernie's monthly picks of the day. You also have a quick view of the picks of the day for various strategies. Covered calls, the weekly picks of the day and monthly picks of the day. Bull put credits, I believe long call as well. I'm sorry, long call is not there. My apologies. But those are some of the ones that you can use as just a quick view to say, hey, what are the weekly picks of the day that came up? Well, as of 1 o'clock Eastern time today, biotherapeutics, exact sciences, and vital farms. So these are positions that are offering a higher return. You can see the information. You really want to read the information about the approach of the picks of the day and see how we develop these results. So you can see what alerts and what stops Ernie recommends when following these search criteria. They're only updated once per day, but I can always see the more updated results. We only have 3 here. It only takes the top 2 or 3 in the quick view. But under the search, still see Vital Farms up there. I'm sorry, this is the weekly picks of the day. Since 1 o'clock this afternoon, it's updated Vital Farms, Wayfair, MicroStrategy, EchoStar holding. That's an interesting one. I've been keeping my eye on for potentially a married put position. There's Arcutis again, Structure Therapeutics, I think was the other one. So they're still there. Canadian Solar's down there. MMYT, that's something I'm in on a married put position right now. It's about a 35% return, I think. Could be as high as a 37% return in the next 5 days, depending on what happens with that particular structure. All right. So again, in any strategy, multiple ways. The search tool, have our defaults. There's monthly, there's weekly, there's a theme search. And under sample searches, you'll see more theme searches, things for ETFs, high liquidity stocks, for bearish positions, looking for stocks in an extreme downtrend, and Iron Condors as well. Some of the sample searches you might see in that one, ETF Iron Condors, index and ETF Iron Condors, and Iron Condors for higher priced security, stocks above $105 per share, with, again, that high probability of expiring worthless and expiring worthless in your favor. So in any strategy, those are the main ways that you can find trades. You can see what we would use, if the criteria we would use if we were opening a position in that strategy. That would be the defaults on the search, whether I want to go monthly or whether I want to go weekly. That's the same criteria I'd be using if I was opening a bull put credit spread today or a bear call. I'd be focusing on that weekly default screen. For a long collar or a debit spread, the long collar position, I might be looking weekly or monthly, depending on what my target goals are. Bull call debit spread and bear put debit spread, I might be using that sample search, out of the money, out in time, looking for positions that are maybe 30 to 40 to 60 days out in time, but not looking to hold the position all the way to expiration, but to close it when I got that 50% return on the position. Okay? So that's the capability. That's what's available to you. You have, in every strategy, you'll see the same sort of setup of stock and option criteria that you can use. Let's just go to Iron Condor, for example, again. So even though we saw it with the covered calls, we saw it with the credit spreads, the options. We've got time frame, setting your days to expiration, shorter term. Oh, that's a 0 day to E test. Let me go to the weekly Iron Condors there. Let's go to that default. All right, there we go. CrowdStrike, Snowflake, Broadcom. So your days to expirations, whether you want to set just it to monthly, standard monthly, or whether you want to use all expirations and just go shorter term. Applied volatility ratios, net credit, minimum return, annualized return, range out of the money for the call side, the sold call or the sold put. How far out of the money do you want to be on either side? The percent of out of money, the range, that's sort of the distance value between the two. If I want something that's right in the middle, where the current underlying price is in the middle of the distance between my short call and my short put, that's what I look for here. I'm targeting an out of the money range of about 50%. So the two short options are equidistant from the current stock price or close to it. I'm not skewed bullish or skewed bearish, but I could do that using this out of the money range. But if I wanted to open Iron Condor, but I thought the market was going up, I might only sell a bull put credit spread on the Iron Condor side that's only 2 or 3% out of the money, and the call side might be 8 or 7% out of the money, for example. You can do that with just the out of the money ranges or with the percent out of the money range as well. Bid price, delta ratios, bid-ask spread limitations, probability above the short put or short call, probability above the short put or short call, probability above or below, I should say, break even, and the percent theoretical probability the stock will be between the two short strike prices at expiration, basic liquidity as well. Okay, so you've got a lot of things that you can screen for, but then the same thing, stock technicals, we want less moving stocks, looking for a Bollinger Band bandwidth of less than 50%. We want lower beta stocks. Don't really want a stock that's trending necessarily up or down. It's a neutral position. We're doing an Iron Condor trade here. But you can customize that any way you want. Of course, as I mentioned, always avoiding earnings between now and expiration. Don't want any subtle surprise. And of course, lists, we're excluding leveraged ETFs, which are more volatile for this basic Iron Condor screen, for the weekly Iron Condors. But of course, you can select from our company list. You just want to screen against S&P 500 stocks, NASDAQ stocks, for example. You have that ability. NASDAQ 100, S&P 100 stocks, stocks just offering weekly options. Well, they're going to appear in this. So everything's going to appear in this search here because next week's our standard expiration. So everything technically has a weekly option next week. But when I'm usually running the weekly Iron Condor screen, weekly credit spread screen for 7 days out at this point, or I'm sorry, any other point than this point, the Friday before standard expiration, you'll only see the limited ones. It's not limited anymore. I still think it's about 700 now, 650, 680, I think, that offer weekly options. It might be higher. But yeah, there's a lot more that offer weekly options now than did in the past, but you'd only have that list there. But of course, in the list field, you can create your own personal list. You just want to screen against a basket of stocks, 10, 12, 15 stocks that you follow. You just want to follow the Magnificent 7 stocks. You could create your own personal list of the Magnificent 7 stocks and just continue to screen against those only with the option criteria or any other fundamental or technical criteria you want to use. Usually if I'm using a list of 10 or 15 stocks, I'm not using any fundamental or technical criteria in that specific saved search that I created. I'll still probably use earnings not between now and expiration if I'm doing standard credit spread or debit spread, perhaps, or even an Iron Condor in that case. But I won't do. There's no need, if I'm just following 7 to 8 stocks, there's no need to really put in the stock criteria as well because I'm just trying to follow those.